Hello, my name's Barney Hawkins. I joined the True Potential Investments team in November last year. As Investments Director, my main task, along with Colin and Chris, is to manage the True Potential portfolios and to keep you informed of key developments in financial markets. The main talking points for investors continue to revolve around Brexit and the Trump administration. As we all know by now, the potential for controversy is extremely high, and for anyone involved in the media, there are rich pickings for sensational headlines. There's little doubt that when uncertainty and sensational headlines collide, they can push investors into taking decisions that should otherwise be thought about in a calm, logical, and factually based manner. Thankfully, our 8 manager partners are all savvy enough not to believe everything they hear or see in the news. In fact, they look to take advantage of opportunities created by overreactions in the markets, because this is what multi-asset funds are designed to do: shift from overvalued to undervalued assets through the cycle. If we turn now to price movements in January, during the month we flagged up the fact that markets in the US and the UK made new highs, and this happened against the backdrop of all the uncertainties that we face right now. The Dow Jones index in the US shot through the 20,000 mark, reaching a high of 20,100 on the 26th of January. 10 days earlier, the FTSE 100 in the UK marched up to 7,343, but has since pulled back, ending the month down very slightly. The broader US market, represented by the Standard & Poor's 500 index, was up 2%, but for UK investors, the strengthening of the pound against the dollar reduced this number to barely positive, as we can see from the chart. The best performing equity markets for sterling investors were Asia Pacific, Japan, and emerging markets. The strong performance from emerging markets is particularly interesting because despite the threat posed by Trump's US administration becoming more protectionist, his pro-growth policies have helped boost commodity prices, which in turn benefit many of the resource-rich countries that have developing economies. Turning now to the bond market, the election of Donald Trump on his pro-growth platform has ignited a serious debate about inflation. By putting America first, some argue that this will push up the cost of goods because there will be fewer imports from low-cost manufacturing centers abroad, and American consumers will have to buy higher-priced goods produced in the US. While this carries the potential to hike inflation, no one knows for certain yet if this will actually happen. Meanwhile, bond investors have taken precautionary steps, adjusted their expectations for future inflation, and have been reducing fixed interest weightings. As a result, some government bond prices have fallen, not just in the US, but also in the UK, with gilts down by 1.9% in January. A shift upwards in inflation expectations represents a headwind for bonds, but this wind blows at different speeds depending on where you're positioned in the market. Higher yielding and shorter duration bonds tend to be shielded more from potential interest rate rises than low yielding, long duration bonds. We can see, for example, that in local terms, global high yield and emerging bonds performed best over the month, although the gains were wiped out by sterling strength. In conclusion, equity markets were quite mixed in January for a sterling investor, with returns from investing overseas reduced by sterling appreciating against the dollar, and UK equities also struggled to make headway. Bonds were also mixed, with global high yield doing well, but UK bonds struggling. Interestingly, an area we tend not to focus on a lot is direct property. This is because we don't own direct property in our funds. In January, returns for commercial property were positive. However, what we noted is that according to the Institutional Property Data Bank, investors gained a lowly 2.6% during all of 2016.
Hello and welcome to the update on our True Potential portfolios. So today I'm going to discuss the performance of the portfolios, what changes we've made, and also look at what are the key themes that we're seeing from our fund manager partners. So before we do this, the first thing that I'd like to do is just to say True Potential portfolios now have over 1.8 billion invested since we launched in October 2015. I'd like to take this opportunity to thank you all for your continued support, but actually why are we seeing such large inflows into the portfolios? What we're seeing is that both clients and advisors understand the benefits of advanced diversification, and the results can be seen from this actually working in practice. Okay, so let's have a look at the performance figures, and as you can see for January, performance in general has been positive. Equity markets don't perform quite well, but bond markets in general have sold off. Over the longer term since launch, you can see some excellent figures with investors being rewarded for taking extra risk with the growth and aggressive portfolios, both posting returns over 20% over the period. So as you'll know, we'll speak to our fund manager partners at least monthly, looking for any short-term key themes, and then we can tilt the portfolios to take advantage of them. First and potentially most contentious theme is what's happening in the US. So one of the main questions our fund managers partners have been asking is, now we're moving away from that Donald Trump honeymoon period, will he be able to push through those domestically focused policies through Congress? So there's a real dichotomy of views here. Some managers are still confident in Donald Trump's ability, whilst others have been reducing exposure to the US, citing high valuations and a potential uptick in volatility as the world digests whether Trump's policies will work or not. Currency has been a major factor in return over the past few months. And actually, if we look over 2016, sterling depreciation has been one of the main contributors to return. The sterling against US dollar exchange rate is historically at one of the lowest levels seen for over 30 years. Our managers are looking at what could happen should this unwind, and certain managers are reducing exposure to US dollars. Others, however, are still bullish, believing that there is further to go and the Trump administration could drive the currency to an even higher level. Okay, so let's now take a look at what's taken place over the month. So rebalances have been placed for the cautious and balanced plus portfolios. So within the cautious portfolio, the True Potential Schroder Cautious Fund has been added to, helping to add to diversification and also reducing the overall model exposure towards fixed interest and increase exposure towards cash. Within equities, Schroder select funds with a value bias, and they'll also identify funds with alternative strategies, again adding to diversification benefits. The True Potential Allianz Cautious Fund has been reduced, and that's because the fund has relatively higher risk levels and a larger exposure to non-sterling currencies compared to the other True Potential funds in that category. So within the Balanced Plus portfolio, the True Potential Schroder Cautious Fund has been added to, and that's for the same reasons that I talked about before for the cautious portfolio. This time, however, the True Potential SEI Cautious Fund was reduced, and that's due to SEI's exposure to global minimum volatility equities, an area of the market that has seen huge inflows during 2016, but as previously mentioned, is increasingly associated with bond proxies, which correlate with bond price movements. Looking at the rest of the True Potential portfolio range, allocations have been kept the same, with the optimization of all four factors continuing to be paramount within the portfolios. Markets are constantly changing, and the feeling is that we're moving towards a different market environment. Diversification is key for investors to reduce risk and to navigate through different market conditions. The True Potential portfolios not only offer diversification by asset class, country and currency, they also offer diversification around investment style, something we feel is essential in changing markets.
Now let's turn to look at the wealth strategy and strategy fund range from True Potential. Firstly, starting off with 7IM, the True Potential 7IM fund range posted some strong figures in January. 7IM are positioned for a brightening outlook but moderate fiscal and monetary stimulation. They project moderate global growth for 2017 and are positioned towards a stronger US dollar. The key diversifiers within their funds are alternatives, such as their inflation-linked note and their dispersion trade. In general, their alternatives have performed well and they have increased their weighting to this area at the expense of bonds, an area they feel could sell off, although they are happy holding a small allocation to US Treasuries. Within equities, 7IM are favouring a value style and have added to Japan, feeling that they could see growth in this area. Lastly, within emerging markets, they are underweight their strategic allocation as a whole and are skewed towards India. Now, Allianz. Allianz have taken a contrarian view to our other fund managers, feeling the equity markets are stretched and nervous that the Trump administration won't deliver. Allianz are concerned that the US dollar is looking too strong and have adjusted their positioning accordingly. They were overweight the dollar, but this has been adjusted back to an underweight position. Allianz have the ability to react very quickly to how events may change markets and can add or reduce risk depending on the levels of volatility within markets. Looking towards 2017, Allianz feel that they will use less of their risk budget compared to 2016. The True Potential Close Brothers fund range was one of the best performers for the month of January. Close are cautiously optimistic on equity markets, but currently cautious on fixed income, keeping an eye on what they feel is a good entry point for yield levels to increase weightings. Starting off looking at asset class weightings, Close Brothers over the last few months have been reducing exposure to fixed interest. The duration of the funds is around 3 to 4 years, with cautious income around 5 years. The big question Close Brothers are asking is how long will the Donald Trump rally last? Close have reduced their exposure to the US and increased their UK exposure, taking the view that they are seeing a honeymoon period since the US election, but are concerned that we could see increased volatility in this area, with markets moving sharply on the slightest comment from Trump. For the income fund, alternatives are now playing a bigger part, with alternatives offering income but also inflation protection. The fund overall is yielding 3.5%. Now turning to Schroders, the True Potential Schroders fund range has posted some solid performance figures over the month. Schroders feel that we are seeing a change in how investors view markets. The last 4 to 5 years they have been concentrating on lower for longer, which has led to massive imbalances in asset classes. Looking at the US versus Europe, Schroders see more value in Europe, with corporate profit margins still below their prior peak, but US margins are now at elevated levels. They feel that the US is more late cycle and that incremental growth doesn't come without inflation pressures. Moving on to fixed interest, Schroders feel that yields are too low to increase exposure currently if we are moving into an environment of rising inflation, and they feel it is dangerous to assume bonds are a low-risk asset in current markets. Schroders hold alternatives as a way to diversify their fund range. Cash levels are around 28% for the balanced fund, and Schroders receive around 0.7% return on cash held, which could rise if yields climb further. The True Potential Threadneedle Monthly Extra Income Fund lost ground over the month as UK equities generally underperformed most other asset classes. As a UK fund, Threadneedle are conscious of how Brexit plays out, but feel that holding a quality portfolio of stocks is the best way to navigate through potentially negative events. Threadneedle are less positive on fixed interest, taking a low duration position of around 6 years compared to the index of 8.5 years. Threadneedle have also been reducing credit risk, reducing exposure to areas such as banks. The fund is currently yielding around 4%, and Threadneedle are positive on the sustainability of this level of income, with a full year of currency devaluations helping to provide higher income levels. For UBS, looking at markets, in the US, UBS feel that there could be a pullback, not necessarily in equities, but potentially more in bonds. Normally where the US leads, other developed markets follow. However, they feel there is a disconnect between the US and Europe. Looking at the dollar, UBS feel that we are in the late stage of strength, although with their currency fund, CARS, they are overweight. Moving on to China, they feel it will perform well in the near future, but could struggle later in the year. UBS are very much positive on emerging markets, feeling that valuations are low and nervousness around a stronger US dollar is overdone. SCI continue to offer a solid performance. They have changed managers, removing AllianceBernstein from their US small cap building block as they felt the team was becoming too large, and style-wise they were more focused on stability and quality as a style. SEI are more positive on the US than many of our other fund managers and do not feel that we will see increased volatility on the back of the implementation of Trump's policies. For the True Potential Goldman Sachs Income Builder Fund, Goldman Sachs remain constructive on equities, increasing their position up to 56% as they feel the equity risk premium is still attractive. They have, though, been trimming financials, tech and profits, reorientating into the oil sector, buying the likes of Statoil. However, valuations remain challenging and there are still tail risks. Looking forward, they feel consumer staples could be an opportunity, previously underperformed but offer better valuations. So for Goldman Sachs Dynamic, the fund is overweight US equities, Japanese equities and relative value. Goldman's are positive on relative value as they see the interest rate differential between bonds and credit spreads tightening. Over the month, they have been reducing that very large overweight position in US equities, which is a reflection that Trump may struggle to push through Congress many of the policies he proposes. They are underweight gilts due to bond momentum, and they feel that we are entering into a new world, but this new environment is still unclear.